Welcome back to the channel. If you're a small business owner or self-employed professional, I need to share something critical about spousal wages that's going to significantly impact your 2026 tax filings. The IRS has been quietly shifting its audit focus, and there's a specific threshold that's creating major headaches for entrepreneurs across the country. Let's talk about the $120,000 spousal wage trap and why this matters more than you might think. The core issue, what the IRS really cares about. First, let's establish what we're dealing with. Many small business owners employ their spouses. On the surface, this looks completely legitimate. Your spouse works in the business, so they get paid. The tax benefits are attractive too. You're splitting income, potentially lowering your overall tax bracket. And your spouse might have little or no other income, keeping them in a lower tax bracket entirely. Here's the problem. The IRS doesn't just accept any wage amount. They require what's called reasonable compensation. This is where most business owners start getting into trouble without even realizing it. According to the IRS's own guidance from recent audit cycles, they are specifically targeting business entities where spousal wages exceed $120,000 annually, but the business's total net income doesn't justify that level of compensation. This isn't a hard rule, but it's become a major audit trigger. Why $120K specifically? It's roughly the threshold where individual tax liability becomes significant enough that the IRS views aggressive compensation claims as intentional tax avoidance rather than innocent mistakes. Below that, they tend to be more lenient. Above that, they're bringing in forensic accountants. Case study #1, the marketing agency, disaster ***. Let me walk you through a real scenario that's becoming increasingly common. Sarah and Michael run a marketing agency in Texas. Their 2025 business generated $380,000 in gross revenue. After legitimate business expenses, office space, software subscriptions, contractor fees for freelancers, they had a net profit of approximately $165,000. Michael is the primary client-facing person and handles business development. Sarah manages operations, accounting, and internal systems. They decided to split things roughly equally for tax purposes, paying Sarah a W-2 wage of $125,000 for her operational role. On the surface, this seems reasonable. Sarah works roughly 40 hours per week, and $125,000 divided by 52 weeks equals $2,404 per week, or about $481 per day. That's within market rate for her position. But here's where the IRS saw red flags. When you subtract Sarah's $125,000 W-2 wages from the $165,000 net profit, you're left with only $40,000 in business profit for Michael's work. For business where Michael is doing significant client acquisition and management, the IRS determined this compensation split was unreasonable. The audit resulted in the IRS reclassifying $35,000 of Sarah's wages as a distribution rather than reasonable compensation. This created several problems. First, the $35,000 reclassification meant Sarah owed self-employment taxes on that amount, roughly $4,950 in additional SC taxes. But it didn't stop there. Michael lost the corresponding business deduction, increasing his taxable income. Combined, they faced approximately $18,000 in additional taxes, plus penalties of $2,700 and interest that continues to accrue. They're now facing a total bill of over $21,000, plus legal fees to fight the determination, which they ultimately decided not to do. Case study #2, the S-Corp strategy gone wrong. Now let's look at a different scenario that's even more problematic. Jason and Jennifer own a consulting firm structured as an S-corporation. This is actually a smart structure for tax purposes, but it requires discipline. Their S-Corp generated $520,000 in net business income in 2024. They decided Jennifer would take a W-2 salary of $95,000, and they distribute the remaining $425,000 as S-Corp distributions, avoiding self-employment taxes on that amount. Here's the math. $95,000 in salary plus Medicare tax on that $2,900 meant total employment taxes of roughly $14,500. If they'd paid themselves normally as self-employed, they would have paid SC taxes on the entire $520,000, which is approximately $73,600. By using the S-Corp structure with a lower W-2 salary, they saved about $59,000 in self-employment taxes. The IRS didn't buy it. During the audit, they applied the reasonable compensation standard specific to S-corporations. The guideline is that S-Corp owners must pay themselves a reasonable salary for the work they are actually doing before taking distributions. For consulting business, where both Jennifer and Jason are actively managing client relationships and delivering services, the IRS determined that a $95,000 salary was unreasonably low. They argued that Jennifer should have taken a $240,000 salary with the remaining balance as distributions. Even though distributions don't face self-employment taxes, the IRS was willing to forego that distinction because the reasonable compensation standard is a statutory requirement, not just a preference. The reclassification resulted in $145,000 in additional wages subject to employment taxes, costing them approximately $31,000 in taxes, penalties, and interest. Asterisk asterisk, how the IRS calculates reasonable compensation. Asterisk asterisk. Understanding their methodology is crucial. The IRS uses several factors, primarily established in tax court cases like RAD v. United States and Elliott's Inc. v. Commissioner. First, they look at the employee's training, experience, and responsibilities. If your spouse has been in the field for 15 years and manages a team, that's different from someone with 1 year of relevant experience. Second, they examine the time devoted to the business. Is your spouse working full-time or part-time? This gets scrutinized heavily. Many auditors ask for time logs, and here's a critical point. If you're paying someone a full-time salary, but they're only working 20 hours per week, that's an audit magnet. Third, they analyze industry standards. If you're in an industry where a controller makes $95,000 on average, and you're paying your spouse $150,000 for the same role, expect questions. The IRS has access to extensive Bureau of Labor Statistics data and uses services like salary, comp, and pay scale in their analysis. Fourth, they look at the business's profitability and financial condition. Can the business actually support this wage? If you're paying $150,000 in spousal wages on a business that makes $180,000 in net profit, that's concerning. The general rule of thumb is that spousal wages shouldn't exceed 70-75% of business net income, though this varies significantly. Fifth, they examine the amounts paid to non-family employees for similar work. If you're paying your spouse $120,000 for bookkeeping, but you're paying an outside bookkeeper $45,000 for the same work, the IRS will absolutely leverage that discrepancy. Finally, they review whether dividends or distributions were paid. If your spouse received $120,000 in wages plus $80,000 in distributions, while non-spouse shareholders received nothing, that's a red flag indicating the compensation is really disguised distribution. Asterisk asterisk RED flags that trigger deep dives asterisk asterisk based on recent IRS audit data and conversations with tax professionals handling these cases, certain patterns almost guarantee scrutiny. First, round numbers. If your spouse's salary is exactly $100,000 or $125,000, suspiciously round figures, expect questions. Real compensation is typically more varied, $118,000, $400,000, $107,000, $600,000, etc. Second, significant year-to-year increases with no clear business justification. If spousal wages jumped from $60,000 to $115,000 with no corresponding business growth, auditors question timing. Third, wage-to-profit ratios that are unusually high. When I mentioned the 70-75% guideline, understand that anything above 85% starts creating audit risk. At 95% plus, you're almost guaranteed to be challenged. Fourth, K-1 distributions that favor the spouse. If your spouse gets $120,000 in wages plus a disproportionate share of profits while you get none, that sends a message about the true nature of the payment. Fifth, lack of documentation. No job description, no time tracking, no written employment agreement, and no evidence the spouse actually performed the work. That's asking for trouble. I cannot overstate how important contemporaneous documentation is. Sixth, paying wages during non-working months. If you operate seasonally but pay your spouse year-round, have documentation showing what they are doing during the slow months. Asterisk asterisk, legitimate strategies that hold up asterisk asterisk. Now the important part. Legitimate spousal wage strategies absolutely exist. You don't have to pay your spouse less than they deserve. Here's how to do it correctly. First, document everything meticulously. Create a job description for your spouse's role. It should be detailed, not just operations manager, but manages accounts payable, accounts receivable, payroll processing for 12 employees, client communications, and inventory management. Get this in writing before they're paid anything. Second, maintain time records. Even simple timesheets showing hours worked make a massive difference in an audit. If you can show your spouse worked 2,000 hours in the year at a rate of $60 per hour, that's far more defensible than claiming $120,000 with no supporting documentation. Third, ensure the amount aligns with market rates. Research your local market thoroughly. If you're in a small town in rural Missouri, $120,000 for an operations manager might be high. If you're in downtown San Francisco, it might be low. Use multiple sources, Bureau of Labor Statistics, industry surveys, comparable positions at similar-sized companies. Fourth, ensure your business can actually support it. Review your net income figures. Make sure you're not paying 90% of profits in spousal wages. Leave room for your own compensation and legitimate business reinvestment. Fifth, make it formal. Treat your spouse like any other employee. Written offer letter, payroll processing through regular payroll, not just paying them from a personal account, W-2 generation, and tax withholding. This formality protects you enormously in an audit. Sixth, ensure your spouse actually performs the work. This might sound obvious, but it's what trips people up. Your spouse must genuinely be doing the job duties you've defined. If you're claiming they manage accounts payable, but someone else actually does it, that's fraud, and the IRS treats it accordingly. Asterisk asterisk, the 2026 focus and what's changing asterisk asterisk, Why am I talking about this for 2026 specifically? The IRS has announced increased enforcement in several areas, and spousal wage audits are explicitly on the list. They're allocating more resources to pass-through entity audits, S corporations, partnerships, and sole proprietorships where spousal wages are most commonly claimed. Additionally, the IRS Criminal Investigation Division has been emphasizing family-controlled business audits. The message is clear. They're focusing on situations where related parties might be entering into tax-motivated arrangements rather than arm's-length transactions. More practically, audit trends from 2024 and 2025 show that cases involving spouses in business are being selected for examination at 3 times the historical rate for similar income businesses without spousal wages. ***, what to do if you're currently in this situation, ***, if you're paying your spouse and haven't been completely documentation focused. Now is the time to get your house in order. Don't wait for an audit notice. First, gather everything you have: job descriptions, time records, market research supporting your compensation choice. Create this documentation now, even if you're going back a few years. While retroactive documentation is weaker than contemporaneous documentation, it's better than nothing. Second, honestly assess whether your spousal wage is defensible. If you're at $120,000 or above, run the numbers. What percentage of your business profit is this? Does it exceed market rates by more than 10-15%? If yes, you have exposure. Third, consider consulting with a tax professional who specializes in business audits, not just general tax preparation. This is worth the investment. A specialist can review your specific situation and identify genuine risks. Fourth, if you find real problems, consider proactive approaches. In some cases, filing an amended return voluntarily before an audit starts results in better treatment from the IRS than having them discover the issue. Conclusion, the spousal wage strategy isn't inherently wrong. Many legitimate business situations involve paying spousal